And just like that, it's as if 6 months didn't even happen in the market. Welcome to On the Markets. My name is Dano Weir. I'm the marketing director for Sonoma Wealth Advisors. We're a financial advisor in Sonoma. You may be one of our clients. You may be thinking about becoming a client. You might have just found this on YouTube. We talk about the market in straightforward English, bringing it down to anyone who wants to learn about what's going on in the market. And that's what today's show is all about. And we are talking about how, once again, shockingly, we are tapping on all-time highs for the S&P 500, despite all of the drama to start the year. We'll also be looking at why having an emergency fund changes your financial well-being. We're going to put gold's meteoric 12-month run in context. And talk about why separating your portfolio from the headlines could benefit you, because that's exactly what happened with the S&P as of today. But first, this. Thankfully, I do not host the show alone. The real stars of the show, they are the managing principals of Sonoma Wealth Advisors, Daren Blonski, CFP AIF, and Chris Sipes, CFP AIF. Chris, we have to give Daren his flowers. We have to let him take this victory lap, because, Daren, you saw this coming.
I didn't see it coming. I said the probabilities were high, Dan, that it was coming.
Chris, did we not say as the tariff? We did a special live broadcast as all the tariff panic was happening, and you said if you've got the guts to really stay in right now, there's a huge opportunity. And as of today, the S&P is back at all-time highs.
Yeah, and again, you never could have known that outcome was going to happen the way it did so quickly, although that's happened many times here in the last 5 years. The market doesn't always recover this quickly. I mean, that was only 3 months, April, May, and here we are at the end of June, and we're back, right? So don't
For real,
always
wasn't it like last week only we were going to have nuclear fallout? Because or was that just me?
I guess potential nuclear war is good for the stock market. I mean, I don't know. I don't know, but nobody else does either, right? And you can't invest based on that. So the important thing is that you kind of understand roughly how your portfolio has performed in the past, right? We always talk about it as an analogy to the weather, and longtime clients are probably tired of hearing this, but if you move to a certain area where the weather is generally within a certain range, that's probably what you're going to expect from the portfolio most of the time. Now, occasionally, does it get way hotter or way colder or severe weather that can affect that area? Yes, and that happens with portfolios too. So it's not always the best it'll do or the worst it'll do, but in general, kind of knowing that range and knowing if that range is okay with you. And so we've said it several times here now that the markets have basically recovered. But if you were someone who was having panic, back in April, and you were thinking, well, this is too much for me, you might reassess now while you're able to do so with a calmer head, less emotions involved. You want to make moves in your portfolio when you're not feeling stress of fear or fear of missing out.
Before we get into the rest of the slides for this week's show, I pulled this, and I have to play this because when I saw that the all-time high was getting close, I needed to pull this clip from June 6th. June 6th, today's the 26th, on our June 6th show titled How to Lose a Guy in 10 Months. Daren said this.
And so people might be wondering at this point, hey, this. Let's just go back to the beginning of 2025. In February, we kind of ramped up to this all-time high, which is right here. And then we saw the tariff freak out, and then we've recovered pretty much all of that at this point. And so people might be wondering at this point, hey, are we going on to all-time new highs? And I'm going to suggest that the probabilities are in favor that we take at least another look, a strong look at the all-time highs, and here's why.
And you went on to explain things as you typically do, Daren. But we have it on record. There it is.
Wow. Holy
there
cow.
it is.
Dano is laying it on thick today, guys.
So there you go. Wow. I was pretty blown away by that one.
He's laying it on thick. Now, if you're looking at this bull market and going, you know what, investing is easy. I can pick the winners. It's so simple. Just look at the good companies, put all my money there. Well, think again, because the history of the markets is one of brutal competition. This from Peter Maluk, and he shows, the largest company by market cap, which means the value put on that company by the stock market from 1960 to 2025. Our logo is blocking what the biggest company is today, but that's Microsoft. Wow, nice, Dan. So Microsoft is the largest company now, but look back to 2010 and then listen to what Peter Maluk says here. He says, in 2010, Exxon was the largest position in the S&P 500. Today, it's not even in the top 15. No matter how strong a company appears, technology, innovation, and competition will eventually come to its doorstep every single time. And I think if you rewind back to 2010, that was right after the global financial crisis. Oil had been north of $130 or $140 a barrel, so super expensive. Now we're, I think, in the 70s. So Exxon at that time, it was the no-brainer of its time, right? And now it's not even within the top 15. So what is, that thing that's right around the corner for Microsoft or NVIDIA or even Apple? Apple's really struggling this year, as an example. It's going to be something that none of us see coming. It's only obvious in hindsight. So be careful with our overconfidence bias in the markets. Speaking of confidence, what is one of the best payoffs that you can get in terms of your financial well-being and confidence? Well, according to Vanguard, having an emergency savings in place, and look at the amount that they have is not unattainable for most people. $2,000. It's not an exorbitant amount, but just by having that much of a cushion, and I don't know how they measured this, but it increased the person's financial well-being by 21%, which, if you look, is higher than even those that had assets of $1 million or more. So getting yourself out of debt, consumer debt, and having an emergency fund, it's not exciting. Nobody talks about that at the barbecue, and if you do, you won't be invited next time. But getting out of debt and having an emergency fund is one of the, if not the best thing you can do for yourself financially, to give yourself well-being, to reduce your financial stress, to probably help your relationship if you're, managing money with somebody else, like a spouse or partner. Doing those two things are worth so much in the financial world, and I don't think we talk about it enough. So it was nice that Vanguard covered this here recently.
People often get itchy, though, because they feel like that's cash that, quote, could be going to work. So what are some vehicles? A lot of people know this, but some don't. What are some vehicles as a financial advisor you recommend putting a emergency fund in, Chris?
Well, you want it to be in something that's going to be extremely low risk or even no risk. So while I can relate to the FOMO that comes from, not earning as much as you possibly could, especially if you're going to bet it on that stock that you just know is a winner, right? But in general, you want to put it in a place where the principal is not going to be at risk. So that could be a savings account as an example. And you want to look less at what it's earning and more at the fact that it can't lose principal. You need it to be there when you need it. Now there's other options. Money market is a common option, although those are not those do have risk to them technically. But in general, those are considered a good option for emergency fund money as well. But you want it to be easy to get to, liquid, and safe. We call it the sleep at night number, right? So that number is different for each person. In general, you want 3 to 6 months of your emergency expenses. Think if you lost your job, if you had to go into emergency mode, you're probably not going out to eat 5 times a week, right? So you don't need to necessarily cover those types of expenses, but you need to make sure that you've got your basics covered. 3 to 6 months is a good place to start. So this week we're talking a lot about narratives, right? And what are the narratives that we get in our head? What's the confirmation bias that all of us have, where we look for things that confirm what we already assume to be true? This one I did not expect. The headline from the White House this week was the Trump administration has no imminent plans to refill the nation's strategic petroleum reserve. The SPR remains at its lowest level since the 1980s. And you can see what that level has been at over time, which was, we started tapping into it pretty aggressively during the Biden administration, coming out of COVID and when the Russia-Ukrainian war started. So going to be interesting to see what happens there, although I'm hearing a lot less about it now that Biden's not in office anymore. You were hearing quite a bit about how much it was being used, and now that's not so much the case. And it doesn't look like, you would think like when the prices of oil are low, that's when we would want to go ahead and fill that back up as a nation, right? And so maybe we'll get lower prices on oil to go ahead and fill that up. I don't know. But nonetheless, we're at a low point in the petroleum reserve. And this may be a reason why, according to Apollo. This was also a narrative buster for me. I feel like I follow the markets pretty closely, and I would not have guessed that the U.S. is the largest producer. I knew we were up there, but I did not guess we were the largest producer of oil in the world. The top 10 largest oil producers by percentage. And you see there, my guess would have been Saudi Arabia, but it is the U.S. thanks to the shale revolution. If you remember back to the great financial crisis, there was talk of peak oil, meaning that we had produced, the most oil that we could produce per day back then. But then they came out with the shale oil technology revolution, I think around 2012 or 13, somewhere in there. And from there, the U.S. took off as the number one producer. And I think that has a lot to do with our stock market's performance over that time as well, given that we've had abundant low-cost energy. We talked a few weeks ago about how a gallon of gas is basically the same price as it was back in 2007. So, you're talking close to 20 years now where the price of gas has not changed per gallon. And that's pretty amazing. That's due to this technology and the U.S. becoming this production powerhouse.
This is shocking.
Yeah.
That today I learned, today years old, that is not that we're ahead, but we're ahead by a large margin over Saudi Arabia. That is not what I expected.
Yeah. So sentiment indicator, this came out today. We're shooting on a Thursday. We normally shoot on Friday, but this does come out on Thursdays. And we're still kind of hovering in that more normal range, still a little bit elevated on bearishness at 40%, because usually we're about a third in each area. But overall, I'd say pretty calm waters now. And then you look at the CNN Fear and Greed Index, that's at 62 greed, which is up a little bit from 55 neutral last week. Bitcoin at 74 greed, up from 57 greed last week. So all indicators looking like people are feeling a little bit better about the markets sentiment wise. Look like a lot of the spending numbers that came out today reflect that. Even though the tariff pause ends in just a few days on July 9th. And so we'll see, although I'm seeing headlines, I don't know if this is true or not, but Lutnick saying that they've signed a deal with China 2 days ago. So it seems interesting that wouldn't have been blasted all over the headlines, but maybe that's why the market has rallied so hard over the last few days here.
I would be stunned if something positive did not make the top headlines. It would be, again, today years old. I couldn't believe that they would report the negative story at the start and then fail to report the conclusion. Who knows?
Yeah. So we cover the housing market a lot because housing drives so much of our economy and markets in the US. And a lot of that's because, one, it's one of the largest things that people borrow money for, and credit creation is one of the biggest things that drives growth in the markets, right? You've got money, which is checking and savings, but then you've got credit, which is many multitudes of the checking and savings. Because if you're going to go say buy a house, you got to get a mortgage, and that credit is created, that money goes into the market, you're paying someone else, that money's going to get spent. And then any homeowner knows you get in there and gosh, you got to put in furniture. And then there's these things that break, and, on and on and on. There's always something that a house is forcing you to spend money on. Well, we've gone through this very, very strange market over the last few years since COVID, really, where interest rates hit all-time lows in 2021. People locked in sub 3% mortgage rates. A lot of people, I think it's 1 in 3 in the US that own homes, own them with no mortgage at all, which is just mind-blowing. And then we've got the largest, or one of the fastest upticks in interest rates in history, to the point where now we've got this market that home prices are still high, which is covering up the fact that the home, the residential real estate market really has gone through an unbelievable recession. Like if you're somebody that's a realtor or a mortgage broker, et cetera, that this is probably worse than the great financial crisis for you, based on the way that the market's just kind of locked up. So we've got low inventory, or we've had low inventory for many years, where we just don't have enough housing stock. You've got an unaffordability of houses. It's leading to all these distortions in the market. I can't help but wonder if it's because, in part, the Fed getting involved in the mortgage market during COVID, pausing mortgage payments, backing the mortgage market, et cetera, that all these distortions are coming through now. But the number of unsold completed homes, and this is by Resi Club by way of Lance Lambert, he says the number of unsold completed new single family homes has once again set another post 2009 high. There's increased slack in the new construction chart. Now they break down the market between new construction, so think brand new homes being built, and existing homes. So we'll look at that difference here on the next slide, where you look at months supply. Anything under 4 is considered a very tight market. So you can see we're just coming out of that tight market in existing homes. When there's tight market, you're usually going to see price increases over the coming 12 months, because there's just not enough inventory, not enough supply to meet demand. And then you get between 4 and around 8 or 9, that is considered kind of like more normal, right? So your prices are probably going to stay about the same. You get above 9 and now you've got slack in that market. And the purple line here is the new single family homes versus existing family homes in orange. And one thing to note is the difference in the two. That's new, at least for this data set. And two is that they're both trending up, but there's still a huge gap between the two. And so if you kind of average those out, we're probably at kind of an average market, meaning that prices nationwide should stay, roughly about even over the next 12 months. But you also notice in those gray lines, those are all previous recessions, that preceding previous recessions, you do tend to see an uptick in the month supply in the housing market, with, of course, the great financial crisis being one of the largest upticks back in 2008. Now, market's totally different now. Most people have a ton of equity in their property. Lending is not as crazy as it was during 2008, so it's not likely we see a situation that's a credit-driven crisis in the housing market. But it's more being driven from the unaffordability of houses at this point, in terms of the slowdown in the prices. Now, where is most of that happening? Well, this is again from Lance Lambert. He says, while the U.S. Census Bureau doesn't give us a greater market by market breakdown on these unsold new builds, we have a good idea where they are based on total active inventory homes for sale, including existing. So pockets of the Sun Belt. So if you think, southeast, southeast, and then of course there's a few spots there in Colorado as well, where you see active listings really ticking up. Now, the Midwest and the Northeast, you're not really seeing that at all yet. And so, real estate is local, as they say. We're more looking at it on a national level, but that's where those pockets are happening. In Florida, really seeing the most stress in their housing market. Now, this is from Jeff Weniger at Wisdom Tree. And, going back to what is driving the stress in the housing market, well, it's unaffordability. And that's driven by the combination of home prices being so high, and the interest rates on mortgages being so high. So he says there used to be an old rule of thumb: don't spend more than 28% of your income on housing costs. For the median household, 28% of their income is $2,019. But on the median house right now, the combined cost of mortgage, HOA, tax, and insurance is $2,860. And you can see where that is relative to that 28% rule. And this is probably, I would guess, maybe the most unaffordable time in the U.S. housing market to buy a house based on these numbers, even more so than the housing bubble, which again was driven by other factors, different factors than what we're seeing today. Switching gears now to interest rates, and you're hearing a lot about where interest rates should be right now. There's been a lot of back and forth with Powell. Powell spoke to he's the head of the central bank, the chairman of the central bank in the U.S., and he spoke to Congress this week. Now, this is from Mike Zaccardi, and he's showing the Taylor rule. The Taylor rule is a monetary policy guideline that was developed in 1993 by John Taylor, and they use some, different things to come up with where should interest rates be, right? And it's been mentioned many times in the Fed's policy. Now, what does Mike say? He says, Mike says the Taylor rule asserts the Fed should cut, but the gap was also larger in Q2 through Q3 of 2024, meaning that, hey, it may not be as much of a political thing as what's being painted in the news right now. Now look at the gap between the Taylor rule, coming out of COVID. That's when people were quoting it a lot, like, hey, interest rates should be a lot higher, right? That's when the inflation was taking off, and people were saying, hey, why isn't the Fed following the Taylor rule and really jacking up interest rates to try to keep up with this inflation? And then they started to raise them. They got too tight. They started to lower them, and now that spread is closer. So, huge distortions in the market from COVID and the reaction to COVID. And what does the rates market say? The 2-year yield, the 2-year Treasury rate yield, is widely considered what the market's collective outlook on short-term interest rates is. And so if you compare that to the orange line, which is the Fed funds rate, you'll notice that roughly that Fed funds rate has followed that 2-year rate over time. And there are times where that 2-year rate says the Fed is too loose. So if the purple line is above the orange line, that's the market saying the Fed is too loose. And then if the orange line is above the purple line, that is the market saying the Fed is too tight. Now you'll notice we're about 75 basis points spread right now, or 0.75%, 0.75, which is a little bit wide. And so the market is expecting the Fed to cut in the fall, which would bring that spread closer. So there, we are starting to see that gap widen to the point where you would expect to see the Fed start to drop the rates, although I wouldn't say it's quite egregious yet. The second thing to look at is that typically, be careful what we wish for, because usually when the Fed is dropping rates and dropping rates quickly, it's in response to a recession. Those gray lines are the recessions, and you can see that in times past, the Fed tightens rates going into a recession. They're trying to slow down inflation, et cetera. And then we get some sort of crisis, whatever that crisis would be. And then the interest rates drop, and they tend to drop aggressively. And then the Fed does what they can to keep up with the market. So if we continue to see that purple line drop, and especially if you see the purple line drop quickly and dramatically, that would be a red flag definitely for recession incoming. And at the time, it'll be obvious because there's going to be some headline tied to it as to why these interest rates are dropping like they are. I think another narrative that's been missed is the money supply change, right? We talked about how the money supply was tightening, especially in 2022. This is the M2 money supply, or it's just one measurement of the supply of money. And you look at the 1-year percentage change here from Charlie Biello, and he says the U.S. money supply grew 4.5% over the last year, which is the biggest year-over-year increase since July of 2022. After a brief hiatus, money printing is back. Now, what happened in 2022 when that increase happened was, of course, that was when we saw the bottom, the short-term bottom in the markets in the fall of 22, and the market started to take off from there. So a lot of the markets are driven by what's the water level doing, right? Think of the M2 money supply as the water level. It lifts all boats, and that is definitely increasing. Liquidity is increasing, which is probably why you're seeing gold do so well, Bitcoin, stocks, etc., and why the dollar is down 10% year to date.
So you're telling me that the money supply is up 4.5%, and magically year to date the S&P is up 4.6%. Shock's face.
Yes.
It can't be just that simple, right?
No, it can't. It can't be. Total coincidence.
Yeah. Another narrative, and I definitely fell for this one, which was that the foreigners are selling all of our treasuries, right? This is from Ryan Dietrich, and he's showing, at least from the Treasury Department, that foreign treasury holdings remain near a record high. Now, did we get a little bit of a sell-off earlier this year? Yeah, but that's all been erased. And we're back to, an upward trajectory in the treasury holdings of foreigners. Now, there's all different kinds of reasons for that. One reason being that our interest rates are higher, right? So people globally have the option to put money wherever it's going to be treated best. And the United States currently is, if you can get, 4.5% or so on a long-term treasury, hey, that's pretty good relative to other countries. Or short-term treasuries, the same thing, because our yield curve is fairly flat. And so if you can get north of 4% in a treasury, globally, that still looks pretty good, even despite the credit downgrades and the turmoil and the seizing of treasuries, a few years ago. So far, at least, foreigners are still putting their money into these holdings, and they're really doing so at the same rate they have been previously. Where else are they putting it? Gold. Inflows to gold were a record so far in 2025. I think that most, starting to get some questions from clients. Definitely back in April when the stock market was tanking and gold was doing so well, we're getting more questions about gold. But it's going to be interesting to see how that plays out as we kind of go into this we've been in a multi-year bull market for gold. It's kind of sleepily been trouncing most other assets, and not a lot of people are paying attention to that. And I think that's because it's one of those assets that people feel very strongly about. They're either all in and all their money is in gold, or they're just like, nope, I will not touch it. It's, an idiotic investment. There's no yield on it. It's basically against my investing religion to go into gold.
I thought you were talking about Bitcoin there for a second. You were talking about gold.
Yeah. Bitcoin is like the volatile.
Bitcoin's so easy to pick on. I mean, this is
I'm just saying everything that you were saying is also things I've heard about Bitcoin as well. And I'm against it from a religious standpoint.
Yes.
The philosophy. I mean, it's like, that's just funny. That was similar.
Well, they're both kind of measured on something called a stock to flow. Which is where they tend to get a lot of their value from. But it's just Bitcoin's a lot more volatile, or at least it has been so far, than gold. Gold is definitely volatile. It's up there with the stock market in terms of volatility. Now, it's not necessarily correlated with the stock market, so it makes a very good diversifier because of that non-correlation. It just happens to be going up with the stock market right now. And I think 2024 was the first time, I think maybe ever, where they've both been up over, I think it was over 25% in 1 year together. So that's really odd. That doesn't happen very often. Usually they move separately, which is why they're usually a good, why gold tends to be a good diversifier. So
I saw an incredible article this week, speaking of gold, Chris, that within the ocean itself, like within the water, are just very trace amounts of gold, and they estimate that there's $771 trillion worth of gold that's just like locked within the waters of the oceans of the world. But it would take even more money than that to actually to get it out of there. But if they were actually able to extract the gold that lives within the water of the ocean, the entire gold market would be completely reset and crash. So it's just kind of an interesting that, the price of what you're paying for gold is for what's available. It's not actually for the total amount that's actually out there.
If anyone thinks the price of gold is going to drive up the ability of people to get the gold out of the land, the water, whatever, I invite them to come gold panning with me for a weekend.
Yeah, seriously. If Costco can't figure a way to get it out of the ocean, it's probably not going to happen again.
That's right. Well, we now transition in the show, second half of the show. We've looked at some of the fundamentals, some of the economic indicators that is Chris's specialty. And now Daren. Daren hops in with the technical approach, what's actually happening with the lines on the charts. Let's look at that S&P 500 and see it retrace and recover from that April low. Daren, you want to take it away?
Yeah, we can do that and talk all about why the market's doing what it's doing. Let me first go here. We'll share this. So this is the CME Group's probability index, where they're looking at target probabilities of a change in the Fed funds rate. People might say, why? Why is the S&P at all-time highs? Well, guess what? The chances of a rate change are getting higher and higher on the probabilities, right? And that's driving the MAGs, which are those stocks that do particularly well when interest rates go down. Although they did particularly well in the past, I do wonder, though, if interest rates really start going down for all the reasons that Chris just talked about, where we might be looking at recession, certainly in the real estate market, things are plummeting, i.e., Secretary Pulte came out yesterday and said, oh, and you can now use your crypto as collateral to buy houses. To me, it was just a sign of desperation. Now, anyone who listens to this knows I'm a fan of Bitcoin, but I think that was them trying to release a lot of assets that are out there to help prop up the real estate market.
Yeah, I'm not a huge fan of that. I think that just given the volatility, right? And I could be wrong, but they didn't specify like which crypto assets, right? They're not saying like Bitcoin, they're saying like any crypto assets, right?
Yeah, Chris, that's correct. You could technically post your fart coin for buying a new home.
Oh my God. Wow.
Chris, I really wish that I was just kidding with you, but I'm absolutely not.
You know, Dan, you can go ahead and save this audio clip to refer back to, right?
Yeah.
Where I'm going to go ahead and say that posting fart coin as collateral for your house is probably going to be a bad idea down the road. We're going to look back and go, you know what? Not our smartest moment.
You know what I'm going to do is I'm going to pull this out as a reel, and I'm actually going to send it back in time to you guys 10 years ago, and you're not going to believe that what you're saying is reality, or that fart coin's up 2 million% in the last 2 years.
Well, and people that just think we're being crass and call like
we're not.
Is a real.
I really
wish
we were being crass.
I know
not.
it's unbelievable and it's awful, but it's true. There is an asset out there. Well, I use that term very, very.
Oh no!
loosely,
Don't call it that, Chris.
Loosely. Yes. Okay, let's move on. What are we talking
next,
about?
next.
Get out of here.
Abort.
All right, so let's talk about the S&P 500. So the S&P 500 is the largest 500 U.S. based stocks. We did close at an all-time high. Let's look at SPY. This is New York trade hours, and you can see we closed at 611 today, folks. 611. Check that out and change. Our all-time high was back here, and that was in the early part of the year, I should say. And since February, it's been rather tragic in the markets, and now we're looking at all-time new highs. I mean, I don't know. I felt in the last 5 years, I have felt a lot of whiplash when it comes to managing money in the markets, with all of the things going on. But for real, like last week, we were talking about nuclear fallout. Like that was one of the biggest topics out there driving all of the discussion. And the market takes an all-time new high, which is pretty impressive and just speaks to the concentration in the Magnificent Seven, right? And so when these Mag 7, they broke out here and now they're moving up and they have not hit their all-time high. So these are these big 7 stocks that are driving the market. Their correction phase is in the books, and apparently we're on to the records now. So given the trajectory of breaking above this, I think the odds are higher. The mags are going to reach an all-time high, which is going to drive the S&P 500 much higher because of that. So risk on. And that is, there's lots of reasons why I talked a while back about why I thought we would be going on to all-time highs. And frankly, regardless of everything going on, it was in the charts because you can see that bull flag right there. And then we broke out and went up. Now, what I'm looking for to feel like, hey, this is sustainable, because there are instances in history where you had an all-time high, a breakout to an all-time high, and then a crash. It is possible to see something like that. But what I'm really looking for is this breakout above that 600 on the SPY and that retest and that resumption upward. I want to see that there's buyers willing to buy here. Because if you thought things were overvalued down here, you think they're still overvalued here, and they're still overvalued here, and they continue to be overvalued. So this is where the technical guy goes, well, it doesn't really matter what the fundamental guy says about overvalue because the market don't care. And when you look at what's happening with the likelihood of interest rates getting pushed down lower, you look at what's happening with money printer, well, that has to go somewhere, and it's coming out in the markets. Now, what's interesting about this particular move, and we talked about this a little bit before we came in, the 10-year, actually, it went down. And when the 10-year goes down, that's really a nice market for the bonds. And whoa, look at that, Chris. We got a breakout in the bonds, folks. So all you diversified investors out there can take part in some of the victory lap of this breakout because bonds broke out. Interestingly enough, though, that's a pretty significant 4-day breakout on the bonds. We're not in we didn't close out. The only thing we'll see tomorrow, because of the holiday coming up and we've got people heading on vacation, etc. We're filming today on Thursday, but we'll see how the closeout goes tomorrow and see where that goes. But the fact that we're like looking at this high here, that's pretty interesting. I'm really curious to see how high this goes tomorrow, which would suggest that the 10-year is going to continue to go down. Although you can see support right in this range here on the 10-year, and we're coming right into there. So my guess is we're going to come right down into 4.2. We're going to either stall out or we're bouncing from there.
Daren, could we look at that S&P again when you get a second?
Sure.
Because you talked about it being an important psychological point on the graph, and I think that we've mentioned this a couple of times before, but it's still something that I have realized in doing this show and that a lot of people don't, which is that the market is a lot of things, but it's thought to be a combination of fundamentals, meaning like if you're investing in Coca-Cola, their earnings come out. That's just a random stock I picked. Their earnings come out. The stock does a particular movement, and then you say, well, did that movement because their earnings came out. That would be the fundamentals. But the technicals would be that for whatever reason, the stock price is at 100 and people just like the number 100, or that they like that particular price. And you're saying right now you believe that what's going on with the S&P was more about the technicals. That's why you think perhaps that it hit that point. Yes?
Yeah, exactly. It's all about what the technicals are saying, right? So now
there's also a lot of talk right now about, the rise of passive investing and index investing and the flows that come through regularly through things like people's 401ks, right? And a lot of people just look at their investment options, look at what's done the best recently and put all their money in that. And that's kind of that's the extent of their analysis, right? But that has a lot of power on the market when you've got those massive flows going into the market regularly. And so there's a lot of market analysts looking at that going, geez, how much do fundamentals matter anymore when you've got flows like that? And of course, those flows going up can also change based on a narrative shift as well, right? So,
right. Then what happened with the tariff crisis then would kind of be an example of fundamentals, because you've got this absolute bottom in April, and it's very clear that had a lot to do with panic because of the tariffs. That wasn't because of the line. It was because people are freaked out about what could be happening with tariffs. So that would be an argument in the opposite.
Yeah.
Well, I think that's the chicken and the egg argument, right? And that's the challenge with it. It is amazing how often at perfectly plausible technical areas, some piece of data comes out. And I think for the most part, what happens is the market does what the market does, and we construct a narrative for why it did what it did. And I think that's even more true in the world today, as Chris was saying, because so many people are literally every paycheck putting money in the S&P 500 and forgetting if it goes up or down in their 401k. And that's become such a dominant part of the flows of the market that it takes a lot of fear and a lot of behavior that is coordinated to push the markets down, because the buying is just consistent. And wow, thanks for bringing up Bitcoin, Daren. And so that's exactly what's happening with Bitcoin. So people say, how on earth is Bitcoin continuing to go up? Well, the reality is there's enough people through the network effect that continue to buy it and buy it every day or every week or every month or whatever that frequency is, that with a limited supply, the demand just keeps driving higher. And that's what's happening with Bitcoin and why the price is about ready to drive higher. And you can see now, if you didn't believe me here in the S&P a few weeks ago when I told you there was a bear flag or a bull flag right here, and the probabilities are going higher, here's your second chance to believe me. Take it or leave it. Not advice. But this, my friends, is a very large bull flag happening. And this thing is likely to go higher and much higher when it goes.
Chris, we've created a monster.
A pattern is a pattern is a pattern. A pattern is a pattern is a pattern. So,
do not use the royal we with me.
So this extension and then this consolidation period is a classic bull flag. And so when it breaks above 107, you're likely going to see one of these lowercase God candles that you see right here. I think that's what you're looking at with Bitcoin right now. So you can tell me thank you later. All right, let's see. Let's take a look at oil. That was the big one, right? Because a few weeks ago, oil was going to just blow out and go sky high and push us into a recession. And we'll talk about whiplash, man. Like, we were up here, we had a breakout, and then went back down. So this is a good example of why we want to be careful with the S&P breaking out like it is right now. Because you can still have these breakouts happen, and then all of a sudden the trade just goes down. So when all of a sudden the ceasefire happened, the price of oil went down. And what's interesting about the ceasefire, which I don't know if you guys caught much, but what's happened, the whole politics of the Middle East is getting reshaped right now, which I think bodes particularly well for the price of oil.
Well, I heard that they don't know what they're doing. That's what I heard. Something like that. Someone said that perhaps they don't know what they're doing, or maybe it was slightly different than that.
Yeah, I think you could argue whether or not they know what they're doing or not. I mean, the amount of media coverage just to talk about we don't know what we're doing. I have heard about 6 holes in the ground over the nuclear reactor that the U.S. dropped these bunker buster bombs on, and the amount of time and energy and effort and media that has been staring at these 6 holes in the ground and trying to assess whether or not we actually really blew up the nuclear I don't know if they're reactors is not the right word, nuclear or whatever, the nuclear tools they have underground in Iran. But I mean, quite sad, really, that is the state of where we're at in humanity, that we're going to sit there and argue about 6 holes in the ground with all the other things we could be solving in this world. But nonetheless, it sounds like we have peace in the Middle East, at least for now, and the charts scream that. And right now they're saying, hey, it looks like it might hold. The only thing I will say of caution is you've got this area here, which is going to be support for the buyers, meaning a lot of buyers will step in right there and buy oil, and we're hovering above that. But you could argue that this is a bear flag in the formation. So it looks like we're going to be consolidating in here for a little bit, and then we'll see if we go up or down, if that turns into a bottom or it becomes the next leg down. So anyway, that's good news for oil. Good news for us Californians. I don't think we're out of it. There's some really significant issues coming in California with this summer, with a bunch of taxes kicking in on our gas prices. So in about a month and a half, we should be hearing lots of people very unhappy with the amount of gas they're having to pay for gas. FYI. So we'll see how that little journey goes. All right, let's take a look at gold, and we'll wrap it up with gold. Gold, if very similar chart to Bitcoin. Look at that. You got a nice little bull flag happening right there. So if I'm a betting person, I'm telling you, gold probably going to be higher. That to me looks like a chart ready to move higher. So that tells you that people will probably feel even more risk off coming in the near future. My guess is we'll probably see some peace through June, July, and August, and then we go to see the fireworks in September. But that's pretty normal, seasonality speaking. That'll carry on until about mid-October, and then magically things will calm down and we'll ramp into the end of the year for a good solid year. But yeah, I guess our politicians can take their victory lap for now. All right, I think we'll leave it there. Dan, did we lose you?
It helps if I turn my mic on. Thank you so much for checking out the show. I'm going to give a high five to my co-hosts here. We're under an hour, boys. Okay?
Yeah.
All right? They said we couldn't do it. They said it couldn't be done. We didn't take too many rabbit holes this week. And we really appreciate you checking out the show. We put a lot of time and energy into this because we think it's helpful. We love to give our perspective. And if you want to learn more about who we are, if you are a client, thank you for checking us out. And if you want to become one, learn more at sonomawealth.com. You can take our free wealth analysis. Wherever you're listening or watching right now, make sure to subscribe so you don't miss future episodes of our show On the Markets and our other podcasts. Thanks so much for checking out On the Markets. We will see you in 2 weeks.